Okay, in this video, we're going to introduce investing. So we're having a larger unit. Really the majority of the rest of the class is going to be talking about different kinds of investments. So we're going to give a high level of what is investing, introduce this idea of liquidity. So it's a term that you're going to hear a lot over the next couple of weeks. We'll introduce investing in regards to the asset ladder. So, how can we view different kinds of investments in terms of risk? And then we'll talk about a relatively safe investment called a bond or a T-bill, a couple of different things that are involved in this. So this will be kind of an introduction to really the asset ladder and what the next couple of weeks are going to look like. And then there'll be some additional readings and videos to watch for today. So when we talk about an investment, we're talking about something that you were contributing your money to in hopes of getting money back. We have talked about very, very low scale investments, very low risk investments like savings accounts, because they are things that have usually given you interest. So if you put your money into a savings account, you tend to then, you might get a little bit of interest back, like 0.5% or something very small if you keep the money there. And that's something that we can think about when we talk about what makes some investments better than others. So some investments will generate more money than others, or at least have the potential to generate more money than others. Even in our savings accounts, we talked about something that was like a low interest rate, like a short-term savings account compared to like a certificate of deposit. And that's something that also makes investments different is that some are more risky than other ones. A savings account is pretty low risk. It's whatever money you have, compared to something like the stock market, which is much more risky, where you could put your money into it and lose everything. You can make a lot of money, but you can also lose it very quickly. Also similar to the CD versus the savings account, some investments are better than others because sometimes you just need money very quickly. And a savings account is great because you can get your money very, very quickly, as opposed to a CD or, let's say, a house where your money is tied up. You can't get it very quickly. And that idea of getting your money very quickly is an important idea. It's, how quickly you can convert your money, or what we call an asset, into cash is called a liquid asset or liquidity. How quickly can you turn an asset or an investment into cash? So things like your money market accounts, your savings accounts, certain kinds of stocks can easily be turned into cash very quickly, because if you need to buy something, then cash is really going to be able to do it. We would say that they have high liquidity, as opposed to something like I said, a house, where if you want to sell your house, that's great. It can really give you a lot of money, but selling a house is going to take months. It's not going to be something that really happens overnight. So those are not those are not high liquid assets. It's not high liquidity. So that's something that we would just want to know, a term we want to be familiar with over the next couple of weeks. How quickly can something be turned into cash? And when we usually use cash as sort of the standard bearer for everything that we talk about, because cash is the least risky investment. If you have $100, it is $100 everywhere you go. It's not going to give you any more or less interest, but you can spend it at any given moment. It is kind of the standard bearer. So you won't make any money off of it, but you're not going to lose any money off of it, because cash just is what it is. And if we're talking about in terms of riskiness, so how likely are you to put your money into something and get some sort of money in return? This table really shows how, what is the balance between something that is risky, where you can lose your money, and how much money can you actually gain. So you'll see here, cash is at the top. And then next is something called bonds. We're going to talk about those today. And you'll see that those are relatively low risk. So if you put your money into them, you're likely not going to lose it, but you might not get as much back. We'll also talk later on about mutual funds and ETFs, which are a little more risky, but also you can get a little more money from them. Even more risky than that would be stocks. Again, more risk to them in that you can lose your money based off of what stock you purchase, but you can also get more money off of those. And then finally, you can have things like cryptos and hedge funds, that are extremely risky, but also can give you a lot of money. It's a high risk, high reward kind of thing. Other types of investments we'll talk about are real estate, so I already mentioned like housing, and then commodities. So if you were to like invest in gold or something like that, something that's kind of outside of the stock market but still hold value, we'll talk about those kind of separately. And they're, again, in terms of riskiness, they don't really fit into this ladder. But I do want you to keep in mind is that when you make an investment, there are some things that are going to be more or less risky than others, and why something is more or less risky. And is important because it understands there's a big social component to all of our investments. All of our investments are in a lot of ways based off of social engagements, social interactions. Okay, so let's actually talk about bonds. And you're kind of already familiar with this notion of a bond, because a bond is, you'll read this definition, a fixed income instrument that represents a loan made by an investor to a borrower. It sounds very similar to a credit. When we talked about there's someone who is loaning out money and then someone who's repaying it back. In this case here, though, you are the individual who is the loaner. And oftentimes when you have a bond, you are really giving a loan to a bigger corporation or a government. And in turn, they are then taking your money that you are loaning to them, investing it elsewhere, and then giving you money back, usually with some interest. Some of these, we're mostly going to talk about government bonds, because if we talk about corporate bonds, they usually are more like in the stock market, and we'll talk about the stocks, we'll talk a lot about the stock market. But we're talking a lot about government bonds because a bond is a very efficient way for the government to fundraise. You can do this in a very long-term kind of approach. So if you were to get like a U.S. savings bond, so that means you are giving the government a certain amount of money, let's say $100. They are then going to invest it, and then they'll have a long maturity. So you can then get your bond money back with interest after, let's say, 20 or 30 years. And usually the interest on that one would be, pretty decent, around, 3-4%. Depends on how the market is doing when you get the bond. So if the market has a very high interest rate, like it does right now, when the bond matures, you can get a lot of money back. If the interest rates are lower, then you're not really going to get a long-term savings bond. There's not a lot of benefit to it. But right now, again, with high interest rates, if you wanted to get a long-term savings bond, that would make sense, because you could more than double your money when it matures. You can also do short-term, what are called treasury bills, T-bills, and that's you giving money to the government with a maturity date of less than 1 year. So let's say you want to give $100,000 to the government. In a year, they will give you back your $100,000 and then some. Usually for T-bills, though, it's actually it's a little bit backwards. They'll actually give you what the face value is. So if you say, let's say you want to get you want to do a $100,000 T-bill, like the one that's on the screen here. You may not give $100,000. You may only give, let's say, $99,000. And then at the end of the year, when you want to cash in your T-bill, that's when you get your $100,000. So you're actually paying less. And then at the end of it, you're going to get your interest at the face value. So it's a little bit different than the savings bond, which is, again, you put in your $100, and then when it matures in 20 to 30 years, you then get, whatever you put in plus the interest, which could almost double your investment, as opposed to something where you're going to pay less than the face value, but then when it matures in a year, you'll then get the face value. And really, if I'm not sure if you've talked about this in maybe American government, but I know you talk about it in U.S. history. It's a very effective way to do fundraising, especially for a government. The government will then collect a lot of money off of these bonds, where they'll say, all right, if you give us a little bit of money now from a government, like let's say the government looks for these bonds, you give the government some money, they then invest it in things like infrastructure projects or investments, international investments, or, just anything that can keep the U.S. government economy humming. Very big in wartime. So if you want to collect money for, for engineering or for I guess anything associated with war. It's usually very common in World War One, World War Two. You'll hear, you see these kind of posters that you see up on the screen here. The government will invest that money and then pay you back, and that's what actually makes these very secure investments, because they are backed by the U.S. government. You will get your money back because the U.S. government wants to ensure that you get your money back. And the only way you don't get your money back is if something goes on with the U.S. government or the U.S. Treasury, which is something that's just not going to happen. You would need an entire economic collapse in order for that to happen. And believe me, if that happens, then the last thing you're going to be worrying about is whether you get your $100 savings bond, get your savings bond back. So that's what makes them a very safe investment, because they're backed by the U.S. government. This is just a high-level overview. I'll post the presentation on Canvas, so if you want to see it, you can read through these. But these are just the difference between corporate bonds and government bonds. A lot of similarities between them in that they're both intended for usually fundraising projects. The only differences might be how often interest is charged, what are the needs behind each of those. Again, what do the projects really look like in both of those? Is there any sort of risk? So like a corporate risk might have an additional risk behind it because the government isn't backing it up, and something like maturity rates. Okay. All right, finally, after this video, I'll show you another video about what could happen if you default on bonds and why they happen. Fun facts, it's usually not because of the Treasury, but because of a secondary market. So people want to trade bonds between each other, and that introduces a little more risk to it. And then there'll be an additional reading afterwards. So hopefully this is a nice introduction for you for our next couple of weeks in investing. And you can start thinking about what are some things that you might want to invest in. Do you want to do something that's low risk and why? And do you want to do something that's high risk and why? These are big questions that we'll talk about in class.